Tony Crescenzi was talking about sort of the Fed is in risk management mode. Are they doing this right?
Yeah, I would say they overall are doing it right. On one side, they're still worried that the surge in inflation occurred in the first quarter may be slightly more than temporary, even if the latest number suggests a softening of core PCE. But now there's also something of a slowdown of the economy, something of a softening of the labor market. There is job creation, but the unemployment rate has ticked up towards 4%. So there is better balance and there is a slowdown in the economy. So based on their dual mandate, they have to worry about the inflation, they have to worry about growth as well. So I think they're right in waiting until they start cutting rates.
Nouriel, do you think that the risk should be more on the inflation side or the growth side, in that the risk is higher inflation or lower growth? Which camp would you be on?
Well, until recently, I would have argued that the biggest risk was upside on the inflation side. But now economic growth has slightly moderated. Consumption is slowing down. There is some slackening in the labor market. So I think that the Fed wants to achieve a soft landing, but not a softish landing. They don't want to go to 2% with even a short and shallow recession. And therefore, they have to start thinking also about the downside risk to economic growth.
Are we out of the woods yet in terms of we can avoid a recession? At most, we'll get a soft landing?
Yes, with one caveat. You know, a year ago, everybody worried about a real hard landing. Then there was a risk of a softish landing. Then people said, no, we're going to achieve a soft landing. But recently, there was both a growth above potential and inflation above target. So the risk was that actually the economy was growing too fast and will be in a no landing situation. And no landing will lead the Fed to stay high for longer or even higher for longer. That was the risk. While I would say that right now the softening of the growth and labor market side suggests that maybe the risk of a no landing is reduced and we're going towards maybe something closer to the goal of the Fed, that is a soft landing.
In terms of global economic risks and what might keep you up at night, I know that you worry about a lot of things and a lot probably keeps you up at night, but globally, when you look at what's going on in the Middle East, or when you look at what's going on with Russia and Ukraine, what's happening in Europe with those elections taking place in France and the UK, or China, what is the single biggest concern for you as it relates to how the Fed proceeds?
Well, the biggest risk would be some kind of geopolitical shock that will lead to some spike either in energy or broader commodity prices. The initial brutal Russian invasion of Ukraine led to a spike not just in energy prices, but also food, fertilizer, industrial metals. If there was a worsening of the conflict between Israel and Hamas, an escalation that includes Hezbollah and Iran, of course, there could be a spike in oil prices like the one we saw in the stagflationary episode of 73, 79. And the conflict with China is more of a slow motion, a build-up of a Cold War is getting colder, risk of protectionism. And of course, what's going to happen on the trade side depends very much on whether Trump is going to be elected or Biden or some other Democrat as well. So I would say all central banks worry about some geopolitical shock that spikes either energy or other commodity prices that will lead to an increase in headline inflation that could eventually lead to a second round effect of an increase in core inflation and be a stagflationary shock that the increase in inflation reduces growth in a way that will make it really hard the goal of central banks to achieve a soft landing.
Putting aside the U.S. election for a second, because we will get to that, what is the risk that we should put on the French parliamentary second round election and the result of that?
Well, there is certainly a risk that the party of Le Pen reaches an absolute majority. Their fiscal program, the program about Europe, is really, if implemented fully, something will be dangerous, not just for France, but also for Europe. However, I feel that even if they were to come to power, they'll be moderated. They'll be moderated because there are constraints coming from the European Union, from the ECB. There'll be in cohabitation with Macron. And most importantly, there is market discipline. If they were to follow a reckless fiscal policy there'll be a massive widening of their sovereign spread, a fall in the stock market, a weakening in the Europe that will force them to adjust. We know what happened in the UK, where the government of Liz Truss did not survive more than 44 days when the bond vigilantes came into action. So I would say the biggest constraint to a radical economic and fiscal policy in France comes from market discipline, and that's going to lead them probably to moderate if they come to power, if they want to stay in power. The alternative, a hung parliament, is not much better, because that hung parliament implies a minority government. One's going to be subject to a vote of no confidence, eventually a caretaker government, and to policy and political chaos as well. So either way, there are risks in France, but I think that market discipline is going to constrain whoever is going to be in power from doing things that are too extreme.
The rise of Le Pen indicates the rise of populist parties. Are there instances where populist parties are good for markets and for the economy?
It depends. Some of these populist parties start from a, how to say, very populist economic agenda, and then they moderate. In the case of Italy, Meloni, when she came to power, there were worries there'll be a loose fiscal policy, there'll be a reversal of structural reform. That did not occur. And some do hope that Le Pen can be, the way I put it, be Melonized, that once power is going to moderate. There are differences between Italy and France. The program of Le Pen is much more to the right of the one of Meloni. Italy had a carrot of 200 billion euros of low-cost loans or grants from the EU. And Draghi played the role of, how to say, paternal guidance in the case of Meloni. There is not the same figure in the case of France. So they're not, I don't think that France will get under Le Pen fully Melonized, but they're going to moderate compared to what they are right now if they come to power.
Nouriel, when it comes to a lot of the policies, particularly towards China, Biden and Trump actually see eye to eye more than they are facing off against one another. But what you are pointing to is really the threat of increased sanctions and more protectionist policy, isn't it?
Yes, it is. Of course, Democrats and Republicans want to be tough on China, but Biden administration had a view of creating what they call a narrow yard with high fences and concentrating on some critical technological factors and sanctions, while the plan of Trump, at least at face value, is one of imposing a 10% tariff on all the imports coming to the United States, even from friends and allies like Europe, Japan, South Korea, you name it, and up to 60% on Chinese goods. So I would say that the big question mark is going to be whether it's going to head and do that, or whether it's going to offer some carrots and sticks, telling, for example, Europeans that if they spend more on defense or if they change some of their trade policies, they may be subject to exemption from the 10% tariff. Same thing for China. It may gradually increase the tariffs every month to reach eventually 60%. But if China does certain things, maybe it stops short of that. But the point is that any tariff is a regressive form of taxation. It increases import prices, and it causes a higher inflation. What it could alternatively do, and people have discussed it, is the idea of, instead of a generalized tariff, to force the other country to accept the depreciation of the dollar and an appreciation of other currency, something equivalent to the what happened with the Plaza or the Louvre agreement. People talk about a Mar-a-Lago agreement on currencies. But that will be similar in terms of impact on inflation to a generalized tariff as well.
So, Nouriel, if we leave the dollar out for a second, what is the asset class that you think is going to have the most exposure to the volatility of the election based on the policies that we do know? Bond market, equity market?
I would say that protectionism is going to lead to a gradual increase in inflation, and that will be something will be of concern certainly to the bond market, but an escalation of trade friction or a generalized trade war with the rest of the world, because our trading partner might also impose tariffs against the United States, is also a threat to the stock market. A global trade war is not going to be good for the stock market.